In October, major stock market indices hit fresh lows for the year, while the Federal Reserve keeps raising interest rates despite rising inflation. Investors have revalued stocks, bonds, and the dollar due to this. Given the macroeconomic uncertainty, investors may sell stocks. Market timing has historically proven risky. Investors may prefer solid blue-chip companies with high dividends to reduce portfolio risk. These dividend stocks have above 3% yields and substantial upside potential if the bear market ends. Here are the 7 dividend stocks that will make you rich. Number 7. Exxon Mobil Corporation. For a very long time, the energy industry has been a trustworthy hunting ground for dividends. This has been especially true in 2022, when oil and natural gas have been among the few bright areas in the economy. Energy prices, as well as the profits generated by the sector as a whole, have reached their highest point since at least 2014 due to supply bottlenecks as well as geopolitical uncertainties. One of the companies that have benefited the most from this is Exxon Mobil. In addition to this, Exxon Mobil kept the refining and chemical plant assets that it had previously owned. As a result of a surge in refining profit margins and shortages for a variety of chemical items inside industrial supply chains, these are already raking in enormous profits. Even after its significant increase over the course of the previous year, Exxon is still available at a reasonable price. At the moment, one share sells for around 9 times the company's expected earnings over the next 12 months, and dividends on the shares amount to 3.6%. Number 6. Verizon Communications Incorporated. One of the 3 most important mobile phone carriers in the United States is Verizon. Through its Fios branch, the company also maintains a sizable presence in the fiber industry. The substantial expenditures that Verizon has made in 5G and spectrum in order to improve the quality and speed of its network are anticipated to bring the company renewed financial success. Instead, the returns on these investments have been far slower to materialize than was originally projected. When you add in the fact that higher interest rates will make the servicing of Verizon's debt more expensive, it is easy to see why some investors are feeling uneasy about the company. On the other hand, these worries are unfounded. The current price of Verizon stock is only 7 times the company's annual earnings, and those earnings have been constant. Number 5. Enbridge Incorporated. Enbridge is one of the most significant energy firms in Canada. It is a pipeline operator that has mostly concentrated on oil pipelines, and as a result, it has more steady earnings and cash flows than many of its competitors in the pipeline industry. This is due in large part to the fact that Enbridge controls important pipelines that control crude oil from Canada to several refining sites in the United States. Given the current imbalances in the refining supply chain, as well as the regulatory measures that have hindered the building of additional pipelines, this has been of essential importance. Because of the failure of certain projects, such as the Keystone XL pipeline expansion, the value of the already built pipeline infrastructure has increased. During the energy downturn that began in the late 2010s, Enbridge did not reduce its dividend, in contrast to several of its competitors who were forced to do so. The dividend yield offered by the corporation has been increased to 7.1%, providing investors with a substantial income stream derived from vital infrastructure assets. Number 4. VF Corporation. Vans, Timberland, and the North Face are just a few of the many brands that are owned and operated by VF Corporation, a diversified apparel firm that also owns and operates over a dozen other brands. The business is recognized as a dividend aristocrat, and it has increased its payout to shareholders for the past 25 years straight. That is a remarkable achievement in any industry, but it is especially remarkable in the garment industry, which is notorious for its cycles of boom and bust. VF has been successful in part because it approaches its business like a venture capital firm would approach its industry. The company purchases retail brands when they are in their infancy or experiencing difficulties, and then works to grow them into a far more powerful position before either selling them or spinning them off into a separate company. As a result of investors' anxiety regarding the state of the economy and inflation, the value of VFC stock has decreased by more than half over the course of the past year. Because of this, shares now have an appealing value since they are trading at just 11 times forward earnings while still delivering a dividend yield of 6.9%. Number 3. Intel Corporation. The company Intel is having a terrible year. The demand from customers has significantly decreased following the exceptional increase in sales of personal computers and electronics in 2020 and 2021. According to Gartner, a research company that specializes in technology, computer sales have dropped by 19.5% during the most recent quarter compared to the same time in 2021. This is a terrible turn of events for companies that manufacture chips for personal computers, such as Intel and Advanced Micro Devices Incorporated. Not only have sales decreased, but profit margins have also shrunk as a result, since discounting will be required in order to clear out the surplus inventory. Investors, on the other hand, have overreacted. Over the course of the past year, shares of Intel have shed more than half of their value. For a blue-chip stock like Intel, which has a business that is durable, that is an overdone move. Don't forget that the company is also a major beneficiary of the recent government stimulus program for semiconductor companies developing new manufacturing facilities in the United States. This program has been very beneficial to the company. Number 2. Unilever plc. The consumer goods conglomerate Unilever is one of the largest firms in the world. It is a manufacturer of a diverse range of products, including those for personal care, household cleaning, and packaged food. In recent years, it has been difficult for Unilever to increase its revenues since customers have turned away from purchasing some of the company's more traditional products. However, things are not the same as they were in 2020 due to changes in consumer buying habits that occurred after the epidemic began. The inflationary environment has also provided Unilever with a stronger ability to eventually boost prices on the work of the company's profit margins, both of which have been made possible as a result of the environment. To add insult to injury, activists exasperated by years of dismal outcomes have also called for reform at Unilever. This strategy appears to have been successful, as Unilever's Chief Executive Officer, Alan Jope, has announced that he intends to retire by the end of 2023. Unilever has the potential to reinvent itself while also maintaining a dividend yield of 4.3%, thanks to the combination of activist investors, new management, and an evolving environment of consumer spending. Number 1. Canadian Imperial Bank of Commerce. For a long time, Canadian banks appeared to have higher fees and interest rates than their southern counterparts. This made perfect sense in light of the fact that Canada is known for having an exceptionally stable economy and regulatory environment. However, given the higher valuations and uncertain footing of Canada's stratospheric housing market, investors may have preferred to steer clear of the country's real estate industry. On the other hand, things are looking better right now. The property market in Canada has had a correction, which should go forward and lessen the risk for lenders. In addition, the prices of Canadian banks have declined significantly, which has the effect of narrowing the value difference with respect to American banks. The share price of CM has been one of the most affected, falling by around 25% from the beginning of the year to the 14th of this month. This has resulted in the share price falling to less than 8 times the company's expected future earnings, while also delivering a dividend yield of 6%. It would be wise for investors who have been avoiding the Canadian banking sector due to its premium values to take another look at the industry at the present time. What do you think of our video? Let me know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.